Did you know that dividends have played a huge role in building wealth over time? In fact, since 1960, a whopping 85% of the S&P 500's total returns come from reinvested dividends. But not all dividend stocks are safe, and if you're not careful, you could end up losing a large chunk of money. What are dividends? Dividends are like rewards that companies give to their shareholders, who are people that own a part of the company by buying its stock. When a company makes a profit, it can choose to share some of that money with its shareholders as a thank you for investing in the company. These payments, called dividends, usually come in the form of cash, stocks, or any other form, and companies pay them out regularly, like every 3 months. It's kind of like getting a bonus for being part of the company's success. Dividends are important because they provide a steady stream of income from your investments, which can be especially valuable for retirees or anyone looking to generate passive income. They also offer a way to benefit from a company's profits without having to sell your shares. Now that we've covered what dividends are and why they're important, let's talk about how you can use dividend investing to make the most of them. Dividend investing is all about putting your money into stocks or funds that pay you regular income just for holding them. It's a simple and effective way to grow your wealth over time. Let's see how this strategy works and how you can get started. So what is dividend investing? Dividend investing is a strategy where you buy stocks of companies that regularly pay dividends. The idea is to build a portfolio of these stocks so you can receive regular income from the dividends they pay. Over time, as you reinvest these dividends by buying more shares, your income can grow. Kind of like planting seeds and watching them grow into bigger plants that produce more fruit. It's a way to make your money work for you by earning steady passive income. Now, you know why dividend investing is such a powerful strategy. How do dividend stocks actually work? In simple terms, dividend stocks are shares of companies that regularly pay out a portion of their earnings to shareholders. These payments can provide a reliable income stream and even boost your overall returns. We'll break down how these stocks generate income and what you need to know to start investing in them effectively. Dividend stocks work by allowing investors to earn a share of a company's profits in the form of regular cash payments, known as dividends. When you buy a dividend stock, you're purchasing a share in a company. This makes you a partial owner of the company, giving you the right to a portion of its profits. Take Johnson & Johnson, Coca-Cola, or ExxonMobil, for example. These companies have a long history of consistent earnings and regularly share a portion of their profits with shareholders. Typically, these dividends are paid out of the company's profits on a quarterly basis. The amount you receive is based on the number of shares you own and the dividend per share, DPS, that the company declares. Now that you understand how dividend stocks generate income, let's discuss what makes them attractive. 1. Dividend yield. Dividend yield is a simple way to understand how much money you might make from owning a dividend stock. Think of it as the income you get from a stock, compared to the price of that stock. Imagine you buy a share of a company for $100. Now let's say the company pays you $5 each year just for holding that share. That $5 is your dividend. To figure out the dividend yield, you divide that $5 by the price of the stock, which is $100. So $5 divided by $100 equals 0.05, or 5%. This means the dividend yield is 5%. It's like earning 5% interest on the money you invested in that stock. Why is it important? Dividend yield is a quick and easy way to compare different stocks. Let's say you're looking at two companies. Company A, share price is $100 and it pays a $5 dividend. The dividend yield is 5%. Company B, share price is $50 and it pays a $2.50 dividend. The dividend yield is also 5%. Even though the share prices and dividends are different, both companies give you the same income percentage. This helps you compare how much bang for your buck you're getting from different stocks. Note, a high dividend yield might seem like a great deal, but it's not always that simple. Sometimes a company might have a high yield because its stock price has dropped. If the company is in trouble and the price falls, the yield goes up because you're dividing the same dividend by a lower price. So it's important to look at why the yield is high. Also, a very high yield might mean the company is paying out a big chunk of its profits as dividends. While that might sound good, it could also mean the company doesn't have much money left to grow or invest in itself. A practical example. Let's say you're thinking about investing $1,000 in a stock with a 4% dividend yield. Here's how it works. You invest $1,000. The stock has a 4% yield, so you earn $40 a year, 1,000 x 4%. If you hold the stock for 10 years and the company keeps paying the same dividend, you'll earn $400 in dividends over that time. Dividend yield helps you understand how much income you can expect from a stock compared to its price. It's a handy tool for finding good dividend-paying stocks, but you should also consider the company's overall health and why the yield is at a certain level. This way, you can make smarter investment decisions. Now, if you want to make your investment grow faster, you might use a dividend reinvestment plan, DRIP. Instead of taking your dividend payments as cash, a DRIP automatically uses them to buy more shares of the stock. This helps you build up your investment over time without having to do anything extra. It's like putting your earnings back into the pot to get more of the same stock, boosting your overall returns. 2. DRIP, a dividend reinvestment plan. DRIP is a program that lets you automatically use the dividends you earn from your stocks to buy more shares of the same stock instead of receiving the cash. It's a way to grow your investment without having to actively manage it. When you own shares of a company that pays dividends, instead of receiving these dividends as cash, you choose to reinvest them. The DRIP automatically uses the dividend money to buy more shares of the same stock. Sometimes you can buy shares at a discount or without paying commission fees, and by continuously reinvesting your dividends. By doing this over and over, you keep getting more shares, and those new shares will also earn dividends, which get reinvested, creating a compounding effect. A practical example, let's say you own 10 shares of company XYZ, which is priced at $50 per share. Here's how a DRIP might work. 1. Initial investment. Share price, $50. Dividends paid. Per share, $2 per year. Total dividend income, $2 times 10 shares equals $20 per year. Second, reinvesting dividends. Instead of taking $20 in cash, you use the DRIP to buy more shares. If the stock price is still $50, your $20 will buy 0.4 additional shares, $20 divided by $50 per share. 3. Growing your investment. Now you own 10.4 shares. The next year, your dividend income will be $20.80, 10.4 shares x $2 per share. This $20.80 will be used to buy more shares, so you might end up with around 10.8 shares if the price remains $50. 4. Long-term benefits. Over time, as you keep reinvesting dividends, you accumulate more shares. This means you earn more dividends each year because you have more shares, which can then be reinvested again. So, why should you trust me in DRIP? Compounding growth. By reinvesting dividends, you harness the power of compound growth. Your investment grows faster as you buy more shares and earn more dividends. No extra cost. Many DRIPs allow you to buy shares without paying extra fees or commissions. Dollar cost averaging. By buying shares regularly with dividends, you average out the cost of your shares over time, potentially reducing the impact of market volatility. Things you should consider. Stock price fluctuations. If the stock price fluctuates, the amount of new shares you buy with your dividends will change. Lack of flexibility. DRIPs automatically reinvest dividends, so you can't decide to take the cash unless you opt out of the plan. A DRIP helps you grow your investment by automatically using your dividends to buy more shares of the same stock. This process enhances your potential for long-term growth and simplifies investing. By continuously reinvesting dividends, you leverage the power of compounding to build your wealth over time. But to choose the right stocks for this, you need to understand the dividend payout ratio. This ratio tells you what percentage of a company's earnings is paid out as dividends. We'll explain how to use this information to make smart investment decisions. Third, dividend payout ratio. The dividend payout ratio is a measure that shows what portion of a company's profits is paid out to shareholders as dividends. It's a way to understand how much money a company is giving back to its investors compared to how much they keep reinvesting in the business. The company makes a profit, which is often reported as earnings per share, EPS, and decides to pay a portion of these profits to shareholders, which determines the payout ratio. To find the payout ratio, divide the annual dividend per share by the earnings per share and multiply by 100 to get a percentage. Formula: dividend payout ratio equals dividends per share divided by earnings per share times 100. A practical example. Let's break it down with an example. First, company ABC, earnings per share $8, dividends per share $2. 3. Calculate the payout ratio. Dividend payout ratio equals $2 divided by $8 times 100 equals 25%. This means company ABC is paying out 25% of its profits as dividends to shareholders. Why it matters. 1. Healthy balance. A low payout ratio, e.g. 20 to 40%, might indicate that the company is reinvesting a significant portion of its profits back into the business. This can be good if the company is growing and investing in future projects. A high payout ratio, e.g. 70 to 80%, means the company is giving back most of its profits to shareholders. While this can be attractive for income-focused investors, it might also mean the company has less money to invest in growth opportunities. Second, financial health. If a company has a very high payout ratio, it might be paying out more in dividends than it earns, which could be risky. If profits drop, the company might struggle to maintain its dividend payments. Third, consistency. Companies with a stable or moderate payout ratio often have a track record of reliable dividends, which can be reassuring for investors who depend on dividend income. The dividend payout ratio is a simple way to see how much of a company's earnings are being paid out as dividends. By comparing the dividends to the earnings, you can gauge whether a company is giving back a reasonable amount of its profits to shareholders while keeping enough to invest in its growth. Now that you understand the dividend payout ratio, let's explore how you can maximize your dividend income with an IRA. 4. IRA. An individual retirement account, IRA, is a type of savings account designed to help you save for retirement with tax advantages. There are different types of IRAs, but here we'll focus on the Roth IRA. What is a Roth IRA? A Roth IRA is a special retirement account where you invest money that you've already paid taxes on. The main benefit is that when you retire and withdraw the money, you don't pay any taxes on it, including any growth or earnings from your investments. You put money into a Roth IRA from your income after you've already paid taxes on it. For example, if you earn $1,000 and pay taxes on that amount, you can contribute a portion of the remaining money to your Roth IRA. Then the money you contribute grows tax-free. If you invest in stocks, bonds, or mutual funds within your Roth IRA, any gains you make are not taxed. When you reach retirement age, usually 59 and a half, you can withdraw your money, including any earnings or growth, without paying any additional taxes. This can be a big advantage because you won't have to worry about tax bills on your retirement savings. There are limits on how much you can contribute to a Roth IRA each year. For example, in 2024, the limit is $6,500 per year if you're under 50 and $7,500 if you're 50 or older. These limits can change, so it's good to check the current limits each year. Your ability to contribute to a Roth IRA depends on your income. If you earn too much, you might not be eligible to contribute directly. However, there are ways to work around this, like the backdoor Roth IRA strategy. A practical example. 1. Saving for retirement. Suppose you put $5,000 into a Roth IRA this year. Let's say you invest in stocks, and over 20 years, your investment grows to $15,000. Second, tax-free growth. When you retire, you can withdraw the full $15,000 without paying taxes, even though you only originally contributed $5,000. 3. Flexibility. You can withdraw the money you originally contributed, but not the earnings, at any time without penalties or taxes. This makes Roth IRAs a bit more flexible compared to other retirement accounts. Key benefits. First, tax-free withdrawals. When you retire, you can take out your money without paying taxes, which can be a significant advantage if you expect to be in a higher tax bracket in the future. Second, no required minimum distributions, RMDs. Unlike other retirement accounts, Roth IRAs don't require you to start withdrawing money at a certain age. This means your money can continue to grow tax-free for as long as you want. 3. Flexibility. You can withdraw your contributions at any time without penalties. This can be useful if you need access to your money before retirement. A Roth IRA is a retirement savings account where you pay taxes on your contributions now, but enjoy tax-free withdrawals in retirement. It's a great option if you want to take advantage of tax-free growth and flexible withdrawal options. By putting money into a Roth IRA, you're setting yourself up for a potentially more tax-efficient retirement. Let's say you invest in a dividend stock with a 4% dividend yield, use a DRIP to reinvest those dividends, keep an eye on a healthy dividend payout ratio, and do all this within a Roth IRA. Over the years, you'll build up a nice income stream from dividends that grow tax-free, helping you secure a comfortable retirement without worrying about taxes eating into your earnings. By understanding these concepts, you can make your money work for you, growing steadily over time through the power of dividends and smart investing strategies. And that's the scoop. Keep investing, keep learning, and let your money work as hard as you do. If you want to learn more about investing, check out my video on common dividend traps to avoid in 2024, and don't forget to leave any questions in the comments. Thanks for watching. If you found this video helpful, don't forget to give it a thumbs up and hit the subscribe button for more investment tips. Let me know in the comments if there are other topics you would like me to cover. Catch you in the next one. Your financial future is waiting.